evening, ladies and gentlemen. I am Harinderjit Singh, and I am joined by my colleague, Mr. Narinder Wadhwa, from the Shaheed Bhagat Singh College Alumni Association. Our Alumni Association organizes various events for the benefit of our members, students, college, and society at large. Today, we are hosting the webinar on impact of COVID-19 pandemic on investments and Indian economy. And to talk about this, we have two experts and well-known personalities who actually don't need much introduction. There's Mr. Nilesh Shah, who is the MD of the Kotak AMC Limited and is also advisor to Prime Minister on the related subject. He will speak on the impact on investments. And then we have Mr. Madan Sabnavis, who is the Chief Economist at CARE Ratings on impact on economy. Now, before I hand over to Nilesh Bhai, I request you to use the Q&A for asking any questions, and do fill in the feedback form at the end so that we can improve these webinars. So with that, over to you, Nilesh Bhai.
Thank you, Harinderjit. This is clearly the most unprecedented time. We have never seen a medical crisis like this, and hopefully we will pray that we should not see anything like this in the future. There was a movie of George Clooney called The Perfect Storm, where he took his fishing trawler to a spot where 3-4 storms were raging together. Today, global economy and Indian economy is at a spot where medical crisis, economic crisis, and financial crisis is raging together. If we have to take a very simple view, on x-axis is medical solution, y-axis is fiscal and monetary stimulus. If we are very lucky, the medical solution will emerge early and fiscal and monetary stimulus will be like Rohit Sharma's betting. Then the recovery will be V-shaped. We'll go down sharply, but we can bounce back quickly. The most unfortunate scenario will be where medical solution is delayed and fiscal and monetary stimulus is like Joffrey boycotts betting. Then the recovery will be L-shaped. We will go down sharply, but we will not recover quickly. Now, the question which comes in the world of investment is, Nilesh bhai, market what ho gaya kya? Unless until medical solution emerges, we can't say with confidence that market has bottomed out. For market and economy both to bottom out, a medical solution is necessary. Till such time, markets will swing between hope and fear, between optimism and pessimism. Medical solution will be of two types. One, a combination of drug which can cure patients, and second, a vaccination which will prevent occurrence. Between combination of drug and vaccine, we need medical solution, which then gives confidence to the government to resume normal business activity, which in turn will give confidence to the market that now things have been sorted out. Next question then comes, Nilesh bhai, सब कुछ अभी बेच दे क्या? बाद में जब कोरोना वायरस हो जाएगा तब पैसा डालेंगे वापस. But don't make that mistake, because who knows, tomorrow medical solution will emerge and market can bounce from current level. We think markets are likely to swing like a pendulum. Apart from all other factors like global oil prices and economic growth and so on and so forth, 3-4 key factors which will influence market in the short term are number of deaths, number of infections, fiscal stimulus measures, monetary stimulus measures, and most importantly, medical breakthrough. Whenever these news are positive, markets will go up. Whenever these news are negative or absent, market will go down. Today, if we see market, there's no point in valuing it on a P ratio basis, because who knows what the earning is. companies like Infosys, TCS have not given future earning forecast because they don't know how the future will be. So we have to evaluate market on a broad parameters like market cap to GDP ratio. Our 10-year historical average market cap GDP ratio is 76%. Today, we are trading roughly in the range of 50 to 55%. At the bottom in October 2008, market cap to GDP ratio was 43%. So somewhere we are trading below our historical average, of course, not where we had bottomed out. Markets will swing from hope to fear, from pessimism to optimism, but certainly selling at 50-55% market cap to GDP ratio with a hope that it will go to 43% market cap to GDP ratio is not a good trade. नीचे जाने में 10-15% है, ऊपर जाने में 25-30-40-50% भी हो सकता है. So don't try to time the market, bear the pain. Don't look at prices for a while. That will give you a lot of confidence to continue owning your investment. Next question then comes, Nilesh bhai, is it time to be overweight equity? Normally, good news and good prices don't come together. If news are good, prices will be expensive. If news are bad, then only prices will be good to invest into. Now, we all know the bad news. So should we invest? Yes, you can look to be overweight equity at this point of time because we are trading 20% below historical average valuation. Now, 20 does not mean that it can't go to 30 or 25 or 35. Markets are markets. They can trade well below their historical value. But certainly, as we go below historical value, you should be increasing your allocation to equity. My recommendation will be divide your investments on incremental basis in two parts. One part, invest in 10-15 installments when markets are falling. The other part, invest only when medical solution is emerged. That way you will be able to take advantage no matter whether we get V-shaped recovery, L-shaped recovery, U-shaped recovery, J-shaped recovery, W-shaped recovery. In all recoveries, you will be able to average yourself into the market. Don't be in a hurry to invest because markets are trading below historical average. At the same time, don't be fearful in adding small amounts when there is so much of uncertainty, when there is so much of bad news and prices are looking attractive. Then the next question comes ki, kaun si company le? Should we buy stocks? Should we buy mutual funds? What should we be doing? So investment is very simple. It doesn't really require too much complication. If you are stock picker, then you should be looking at 2x2 metrics. दुनिया में दो तरह के promoter है, good, bad, and दो तरह के business है, good and bad. What do I mean by good business? Business whose return on capital employed is more than cost of capital. They are all good business. कमाते हैं 10%, देते हैं 8%, तो 2% shareholder के लिए बच जाएगा. Bad businesses are businesses which earn 8% but end up paying 10% or 12% interest rate. तो आज नहीं तो कल वो bankrupt होगा ही होगा. Similarly, who are the good promoters? Good promoters are promoters who will do good job. They'll work hard for you. And most importantly, will not cheat you. Their corporate governance will be very good. Who are the bad promoters? जो आपकी जेब से पैसा निकाल के खुद का घर बनाएगा. Now, if you are making investment, you have to buy good business run by good promoters. That's the sure way of making money. If you want to lose money, then buy bad business run by bad promoters. अगर industry ने नहीं मारा तो promoter आपको लूट लेगा. On the other end, if you want to invest in good businesses run by bad promoter or bad businesses run by good promoter, be a trader. Don't be a long-term investor there. कभी कुछ सस्ता मिल गया, ले लिया, बेच दिया. So in this 2x2 matrix, you can actually figure out what needs to be done. If you don't have time, inclination in finding out business and finding out promoter, then mutual fund is appropriate. नेक्स्ट क्वेश्चन देन कम्स कि म्यूचुअल फंड में भी बहुत सारी स्कीम है, स्मॉल कैप, मिड कैप, लार्ज कैप, मल्टी कैप, सेक्टरल. Where should we invest? My recommendation is that right now, please invest in diversified basis. Don't go into concentrated basis. Of course, some sectors, some companies will do well, others will not do well. But today there is so much of uncertainty. So much of behaviors are going to change going forward. In such scenario, diversification will lower your return, but also lower your risk. And going diversified will be better bet. Avoid sectoral fund, go into simple diversified fund. Today, market is like time travel machine. You can go back 4 years to buy large cap stocks. You can go back 6 years to buy mid cap stocks. And you can go back 9 years to buy small cap stocks. लाइफ में कभी कभी ऐसा मौका मिलता है कि आप 4 साल, 6 साल, 9 साल पीछे जाके मार्केट से शेयर खरीद सकते हैं. If you are conservative investor into large cap funds, they are relatively less volatile and they are likely to bounce first when this correction is over. If you are average investor, then go for multi-cap fund or large and mid-cap fund. They will be little more volatile compared to large cap fund. They will give little more return compared to large cap fund. But for average investor, they will be more suitable. If you are aggressive investor who wants highest return, then go for small and mid cap fund. These are highly volatile fund. उसमें आप बैठ गए तो roller coaster ride याद दिला देगा. But if you stay invested for a longer period of time, this is where you can make maximum money. Though there is one caveat, the past experience suggests that normally large cap moves first and then only small and mid cap moves. Then the next question comes, Nilesh bhai, other than equity, if there is any asset class to look into, well, gold looks attractive. In an era where interest rates are low and liquidity is high, gold prices generally does very well. Now, in November 2008, gold had corrected from $1,000 to $750 due to subprime crisis. And then it went all the way up to $1,900 because of lower interest rates and high liquidity. The same scenario is likely to prevail now, where interest rates are low, liquidity is abundant, and gold prices have already moved from $1,450 to $1,750. Our expectation is that gold will continue to move forward. Of course, gold is a commodity. It will go up and down, but in the era of low interest rates and high liquidity, gold can go to much higher level. Gold also has a secret option. Today, China has more than $3 trillion FX reserves in hard currencies like dollar, yen, euro. In 19 countries, China is facing cases for COVID-19 related cost. In US, one state itself has filed a case against China for COVID-19. What if one of the judge tells that go and confiscate China's assets and use it for COVID-19 costs? Whether that will happen, not happen, who knows? But could that fear push China to buy gold? If that happens, you can imagine what will happen to gold prices. So gold is one investment worth looking at it. If you are looking to buy on a 1 to 3 year horizon, then physical gold and gold ETFs are options. If you are looking to buy 5 to 7 year horizon, then gold bonds are better. In gold ETF, we charge fees. In gold bonds, you get interest income from government over and above gold price movement. So gold bonds on a 5 to 7 year basis will be far better. But 1 to 3 year where you probably need day-to-day liquidity, then gold ETFs are better. Otherwise, physical gold is also a suitable option. Next question, which comes on investment side, is that, chalo equity ho gayi, gold ho gayi, what about fixed income? And especially after Franklin Templeton shut down their 6 schemes, there's a lot of fear, is money safe in fixed income mutual fund? Well, what happened with Templeton is an isolated event. Post their announcement on Thursday, we did see redemption pressure on Friday and Monday. It eased off over a period of time courtesy RBI's intervention. And despite getting unexpected redemptions, all other mutual funds were in a position to pay by liquidating their portfolio. And today, without resorting to any borrowing, all mutual funds are operating in a normal manner. If you look at our portfolios, which is available on our website every month, you will see the names which you will be comfortable remaining invested into. Don't take my or any other fund manager's word for granted. Go for see for yourself, verify for yourself, is the portfolio worth investing or not? My guess is that your judgment will be as good as our judgment, that it makes sense to remain invested in mutual fund. On interest rate side, again, we see a pendulum kind of movement. At some point of time, RBI will intervene to lower interest rates. At some point of time, it will withdraw from intervention, which will again allow rates to move up. And that's how the pendulum will continue to move. Theoretically, Indian yields can come down significantly from current level. But looking at all the uncertainty, I think that will be a fairly gradual process. But in the intervening period, yields will continue to swing depending upon RBI's policy decisions and intervention. The best thing in the fixed income right now could be dynamic bond fund, where fund managers can take a call on the duration looking at the yield. And over a 3-year period, most dynamic bond funds have delivered better return than bank fixed deposits. This is how we broadly see the markets going forward. It's going to be one of the most unprecedented crises. That's why prices have come down to this level. And if you are a disciplined investor, and if you can remain overweight equity and gold in this phase of investment, I'm sure over a period of time, this will work out well. One question which has come many a times and I'm taking the liberty to answer is, Nilesh bhai, SIP chalu rakhe kya equity fund mein? The SIP returns are negative and should be continued. So I'm just giving example of Kotak Emerging Equity Fund, which is our mid-cap fund. If we looked at 12-month SIP return on Jan 20, it was coming at 27%. In March 20, when markets fell, it became minus 41%. So plus 27 se minus 41. In the month of April, by which market recovered a little bit, it became minus 21. Now just look at the range. In Jan, it was plus 27. March, it became minus 41. In April, it became minus 21. However, if you look at 10-year SIP returns, of course, it fell in March, but it was still positive. In Jan, it was 17%. March, it became 9%. And in April, it again crossed double digit at 11%. More importantly, these funds delivered significantly over benchmark index. On a 10-year basis, the benchmark outperformance is 5 to 6%. So if you continue your SIP, of course, today's returns are not looking very good on a 1-year basis, but they're still looking decent on a 10-year basis. As the markets improve, once medical solution emerges, whatever you have bought now will get mark to market at a much higher level. But if you don't buy anything when things are attractive, then how will the returns come? Our recommendation is that you continue your SIP unless until you have a financial emergency. Stay invested in this market because prices have become attractive due to all the volatility, due to all the uncertainty. They will still swing till such time medical solution emerges. But once medical solution emerges, whatever you have bought at current valuation, current market level will start giving you far better return. This is how we see the world of investments. Happy to take questions.
Nilesh bhai, let me go first. and then I would ask Narendra also to take the question is, you talked about the small and medium caps versus the large caps. Historically, when you have this kind of a situation, when the recovery starts to happen, is it that the large cap leads the recovery, or is it the small and medium cap leads the recovery? Can you just elaborate on that part?
Sure. Harinderjit, past experience suggests that first movement happens with large cap. Large cap is like the engine. जब तक engine नहीं हिलेगा, पीछे mid cap, small cap की bogie नहीं हिलेगी. But last few days has been exceptional. Mid caps are falling less than large cap and rising more than the large cap. Now, could this be aberration or could this be that markets are mature? I don't know. But I will still put my money that large caps will move first post correction and then only mid caps and small caps will rally.
Okay. Over to Narendra ji.
Thank you, Harinderjit. Good evening, everyone. I am Narendra Vadva. I welcome our distinguished guests, Mr. Nilesh Shah and Mr. Madan Sabnavis. As Harinderjit mentioned, they both require no introduction. We see them on electronic media every day, and they are wizards of the financial world. It is our privilege to have them on our webinar. As the nation goes through a period of staying at home, this is the best time to enhance ourselves and take a deeper look within, to enhance our knowledge and sharpen the skills. We know famous Darwin theory, which says all our ancestors were monkeys. Another theory speaks about the survival of the fittest. And one more, it says that very important theory that not the strongest and the biggest are the winner, but the most responsive to the change are the winners. As a proactive and responsible alumni association, I compliment our alumni team for this initiative to sharpen members' knowledge. Nilesh bhai, thanks for joining us today on this webinar. As a market participant, it is always a treat to listen to you and learn finer points of investing. Our audience today are alumni members. Many of them are finance professionals, academicians and students of economics and finance of Delhi University. Although your presentation was quite comprehensive, but I don't want to miss today's opportunity to ask my question. There is a famous market wisdom and quote by legend Warren Buffett that invest when the market is fearful and sell become greedy. My question is our capital market really fearful currently because of the uncertainty? Over to you.
Definitely, Narendra ji. Good news and good price don't come together. You have to catch falling knife. That's how you make money in market. It's not the timing the market, but time in the market which makes money for you. And if you enter the market when valuations are cheap, when valuations are below historical average, you will always make money. So this undoubtedly is the time to buy, knowing fully well that there is risk of medical crisis, economic crisis and financial crisis. But if you pick up right stocks at today's prices, whenever medical solution emerges, they will deliver better return.
So I'm getting few questions from participants also. To sum them up and pose you their question. Their common question is, with falling interest rates on FDRs and saving interest rate, what is the outlook for average Indians in the near and long term? Historically, India has been a very good saving, and saving is in our blood. One statistics I want to share, at 2.5 trillion economy, we save around 20 lakh crore per year. Going forward, if we reach 5 trillion, simple mathematics is we'll be reaching 50 lakh crore or 40 lakh crore per year. So what are the avenues on different asset class? And one more question related to this. We are seeing many things which we haven't seen before, like crude oil at negative rates, Franklin Templeton episode, what all these things are indicating for investment?
So crude at negative is actually not a big thing. It was a derivative trade settlement price. It was not as if you will go to petrol pump and petrol attendant will pay to you. It's not as if India, when it went to buy crude for the month of April or May, it got paid for buying the crude. It was just one exchange where buyers had to take delivery of crude, but they didn't have godowns available, storage available. Hence they requested seller कि भैया मेरे सर से ये बंदर को उठा ले, और उन्होंने अपनी कीमत मांग ली. Now this kind of things happen in the market. Coming to the saving side, well, we are not that great savers. Our savings ratio is 30% of GDP. Countries like China have much higher savings ratio. Now, at 30% savings to GDP ratio, we can't grow at 7, 8, 9%. We can only grow at 5, 6, 7%. We have to save more, and more importantly, we have to invest it wisely. Even if at $3 trillion economy, when we look at 30% savings, that's about $900 billion. Half of it will be going into real estate, some in bank deposits, some in insurance, some in mutual funds, some in gold. So we are not really having enough savings to sustain our own GDP growth at higher level, and which is where we have to get foreign capital. If all of us can increase our savings, it has its consequences, because if I don't consume, that also has an impact on economy. So we'll have to balance our savings in a manner where it's optimum between spending and saving. And more importantly, it is more in financial assets than in physical assets, so that our entrepreneurs get enough capital to set up businesses and create growth opportunity.
Thank you. One last question. See, we have all heard Japanese Prime Minister and leaders of US and other worlds encouraging their industry to shift manufacturing base from China to other jurisdictions. I see huge opportunity for India. My question is this a real opportunity for India? I know you can't comment on specific shares. My question is in this light: what are the sectors one should focus for investment, especially when our PM talks about self-reliant and when the world is looking inwards to produce everything? Sectors where one can look at this point of time.
See, this slogan of Atmanirbhar Bharat is in right direction, but it is being misconstrued. It doesn't mean that India becomes an island economy where no import is allowed, no export is permitted. When we say Atmanirbhar, effectively it means that we are exporting more than importing. Instead of exporting raw materials like iron ore, we are exporting finished products like motor cars. Instead of sending our manufacturing industry abroad, we are bringing manufacturing industry to India. So it should be not construed as going back to 60s and 70s where we were an introvert country, but we should be seeing this as a country which allows you to be part of global supply chain management with a trade balance which is in your favor rather than against. In 1980, India and China were of similar size. They became manufacturer to the world. We missed the bus. Today, China is 4 times bigger than us. We became back office of the world, but they became manufacturer to the world. Now we have to bring those companies out of China to India. Today, image of China has taken a beating, and image of India has gone up a little bit, courtesy hydroxychloroquine tablets which we are sending. Now we must encash this goodwill in form of higher investment in India. Because of China's conduct, companies wants to move out of there, but there is severe competition from Thailand, Cambodia, Vietnam, Bangladesh, apart from Korea, Taiwan, Indonesia, Malaysia, Singapore, Mexico, and so on and so forth. Now, those countries have better infrastructure than India. Their policy making is better than India. The only way we can bring these companies against that competition is one, we can give them access to our large domestic market of 1.36 billion consumer. बाकी सारी countries को combine के कर लो तो उनके पास 136 करोड़ लोग नहीं हैं. Second, we have to encash the goodwill which India has created. And third, we have to make them welcome, like Tata Motors was welcomed in Sanand. Tata Motors tried setting up their automotive factory in Singapore for years, didn't work out. They came to Sanand on a SMS of Suswagatam and got settled in 18 months. And Nano's car started coming out of factory in 18 months. Land was given, pollution, environmental approvals were given, power connection was given, a 24/7 helpline was there to ensure that your factory comes up. Infrastructure around the factory was developed in terms of connectivity. And boom, in 18 months, Tata Nano came out of the factory. What we did with Tata Nano in settling in Sanand has to be done with this 200, 300 odd companies which are coming out of China. By giving access to large domestic market and by giving red carpet treatment rather than red tape, we will be able to get fair share of companies from China to India. And how big this opportunity could be? Well, look at Samsung, a Korean chaebol. They came to India long before they went to Vietnam. Their turnover in India is about $12 billion, about $10 to $12 billion. They make in India and sell in India. They went to Vietnam much later. Their turnover in Vietnam today is $62 billion. In a country which is 1/10 the size of India, their turnover is 5 to 6 times higher than India. They contribute 28% of GDP to Vietnam. Their contribution to GDP in Vietnam is more than government of India's contribution to Indian economy. Vietnam has outperformed India for last 10 years. The reason is just one company, Samsung. Now, how do we bring such Samsungs from China to India? How do we allow them to flourish in India like they flourished in Vietnam will determine how quickly we become $5 trillion economy. We have the role model. If India welcomes companies out of China like Singapore, there is no hope for us. If we welcome companies like Sanand, there is a great opportunity for us and we'll close our gap with China, which we had forgotten to choose in 1980.
Thank you, Nilesh Bhai. Such a pleasure to listen to you. Hope you stay with us till the end of this webinar. Now, let me introduce Mr. Madan Sabnavis, our guest and key speaker on economy. He's an chief economist with CARE Ratings since 2010. He has been economist with NCDEX for 6 years and L&T for 2 years before ICICI Bank. He is author of 2,500 articles and has written 3 books, latest being Economics of India. The title is How to Fool All People for All Times. Over to you, Mr. Sabnavis.
Yeah, thanks, Narinder. It was very nice listening to Nilesh, and I think I'm sure everybody benefited from that. Now, actually, sometime back, I think it was in the beginning of April that Narinder had actually invited me to be a panelist to talk on the very same issue. I think it was an ASSOCHAM conference. And at that particular point of time, it was just the beginning of April. And one always said that, look, we're not quite sure about where exactly we're going. I think we were in the lockdown 1 stage. And today we are in lockdown 3, and maybe there's a 4 coming up from what we've read in the media. The question is that are things clearer today than they were maybe 1.5 months back? I think the answer is actually a shoulder shrug, because we are not really sure if things are very much different. And I think even if you look at the government, they're not also quite sure about whether we should be opening up or should we be continuing with the close down. And it's quite simple that really one doesn't know whether we took a right decision. Maybe from the point of view of saving lives, we did. But today, when we read reports about the number of cases of infection, they've actually gone up. And it doesn't seem to look like that the numbers are going to come down. They're only going to keep increasing progressively. And at the same time, we have realized it's a harsh reality that by just all of us sitting at home and some of us manage to work from home, it's not something which is viable. And people don't have money. We're not producing enough. We don't have money to spend. And there's a lot of agony which is there at the micro level. So therefore, there's this entire debate about whether we should be opening up, and if we have to open up, how exactly we should open up. And I think this kind of discussion seems to be carrying on. And it does look like that we may have to wait till June 1st before things do open up, even in a meaningful manner. So every time we talk of gradual relaxation, something is open, then we close it. Sometime back we said trains will start functioning. We want to stop them now. We said airlines will start functioning. Now we're saying come and take your refunds. We said we will allow liquor to be sold. Then you suddenly say, no, liquor won't be sold, but we'll deliver it to your house. The reality has actually hit the government that there is no revenue coming in. And while it was okay to say that people like you and I were not drawing our salaries or getting a partial salary, now you suddenly realize that the government will not be able to pay for their own employees. You will not be able to pay the doctors. You will not be able to pay the teachers, simply because there's no revenue which is flowing in. So therefore, there's this fundamental issue which has come up upon whether this lockdown actually makes sense and whether it is actually sustainable or viable. So this goes back to saying that finally we need the economy to be moving. And maybe after around 1.5 months of this lockdown, we are in a better position to say about what exactly economic growth is going to be like. We have a better idea about how sectors are faring. And we also know as to what are the main challenges which lie ahead when we think about moving away from the lockdown, partially to begin with. Now, in terms of economic growth, I think various people have different kind of estimates. We have some of the international investment banks which are talking of -10%, -8%. We have the IMF which spoke something of around close to 2% or 1.8%. The UN said India and China would be the so-called stars in this entire bleak story. The RBI has played very prudent, because the RBI had said that it's not possible for us to take a call on GDP growth when we don't know how long this pandemic is going to last and how long the shutdown is going to last. But as economists, we are always forced to give a number. And therefore, we at CARE Ratings sat down and thought, let's be as objective as ever when we calculate a possible GDP growth number. And the best possible scenario for us today is 1.1, 1.2%. And this is based on the assumption that things will come to 50% of normal in the second half. And to arrive at this particular number, we thought, let's look at the various sectors. And since we have considerable expertise in terms of analyzing different sectors, we thought, let's see how the sectors are actually performing or likely to perform in the financial year. Now, what have been the bright spots, I would say, which is driving this growth is agriculture. I think the IMD has said that the monsoon is going to be normal. It's a precondition, though not an adequate or a sufficient condition for a good monsoon, but at least we have news that the Kharif crop could be normal. And Kharif contributes around 50% of our agricultural output. So that is some good news which we have there. We look at the manufacturing sector. We're looking at the essential goods, the FMCG products in particular. They are the ones which are doing well. They were operational even in the months of April and part of May, even though there were lots of challenges which they had because of, I would say, poor communication from the top to the bottom, because we have a federal structure. The central government says something, the state governments have their own rules, municipals have their own rules, the panchayats have their own rules. So while the central government said that all essential goods should be produced and delivered, that did not quite happen. So there were definitely hiccups along the way, but the FMCG companies are definitely those which are doing well. Food products included in FMCG are doing well. The pharmaceutical industry, as borne out even by the stock price movements of, we have seen is one sector which is doing very well and which will continue to do well. There will be more investments both from the private sector as well as the public sector, that is from the government sector. So therefore, this can be something which could be driving the economy going ahead. But the story on the manufacturing side actually stops here. Just the FMCG and the pharmaceutical sector. If you ask other essential commodities like steel and cement, which ideally should also be moving around at a fairly good pace, they have certain problems because there's a problem of demand. Because while steel and cement can be produced, we need to have people who are willing to buy them. And today, if you see, the main purchasers are the government and the private sector. Private sector investment has come to a standstill. So therefore, there is no investment taking place. There's no demand coming there. The government has announced saying that for the first quarter of the year, at least, money is going to be spent only on relief activity, not on any capital projects, which means that the demand for steel and cement, especially for the road construction, gets impacted. Now, if you look at the services, we have seen that certain services like aviation, hospitality, entertainment, tourism, media, I would say there's been a total washout, and it looks like that for most of the year, these segments are going to be at the background. It's going to take a very long time because lots of these services involve social cohesion rather than social distancing. And as long as we move around with masks on our face and maintain 6 feet distance between one another, these industries are going to find it very hard to recover. If you look at something like trade, retail trade, definitely in terms of non-essential commodities, they have been affected. And that's a very large segment when you're talking of retail trade. Online works only for essential goods. So e-commerce has gotten some kind of a boost, but very limited. We have seen that the major e-commerce industry, companies are doing well when it comes to essential goods, but they're having problem in terms of procurement. But otherwise, their business is just moving maybe around 25, 30%. They're experimenting more in essential goods. So instead of selling garments and mobile phones, you're now coming into selling gehu and atta and pulses. It's not really something which can get you lots of revenue, but at least keeping that particular chain moving. If looking at transportation, railways have come to an end. Maybe freight was going on, but we're not seeing passengers moving. There's a limited commitment shown towards opening certain railway routes. So therefore, there will be some kind of traction. One can hope that depending upon how it pans out and how social distancing is maintained and how these cases turn out to be COVID positive or not, there would be further action taken for railways. But practically speaking, I think up to September, we'll be moving with limited passenger movement on our trains. In terms of road transport, I think it's very vital in terms of passengers. A lot of individuals in India, especially the lower income groups, moves on state transport buses. As long as the borders are closed, which looks likely, because even today I was seeing on the television, when we are talking in terms of opening up of the airlines, everybody has said that we don't want people from Mumbai to come to our states. So just think about Maharashtra, probably the leading industrial state. There'll be maximum number of people going up and down, but all the other bordering states, Gujarat, Madhya Pradesh, are going to say, look, we don't want people from Maharashtra to come here. We don't want buses to come here. So I think road transport minus freight is going to take, again, another 6 months minimum before it's able to get back on roads in a literal sense. So therefore, the entire service sector we have seen is something which is going to be impacted very sharply. And quite interestingly, we have seen that when the PMI numbers for services came out for April, it came as 0. I mean, never heard of it, and it was quite expected because if nothing moved, no service was there, the PMI would be 0. Similarly, if you're looking in terms of the PMI for manufacturing, it came down to something like 25. Anything above 50 is positive, below 50 is negative. So PMI at 25 means virtually there's no activity which is taking place. But what is going to be the major driver could be the government, because when we calculate GDP, we have the government sector, public administration and services, which accounts for around 10 to 12% of our GDP. So as long as the government is spending, and even if the government is not spending on capital expenditure, but it's spending on revenue expenditure, I automatically get my GDP moving in the positive direction. I look at the banking and services, the entire BFSI sector, it has been largely operational. We're all operating in a very non-conventional way of working at home. But yes, banking business is carrying on, stock market business is going on. So therefore, we have seen that the BFSI sector is something which is going to add something positive out there. If you look at the telecommunications sector, yes, that's another positive thing. A sector which was actually down in the dumps in February on account of all the controversies we had regarding the telecom players. Suddenly we have seen that the traffic has improved. We ourselves are conducting our programs using the telecom services, which otherwise we might have been doing in some hall of a hotel. So the hospitality industry is down. no more seminars out there. Maybe we'll be using the web more for more of our communication, which means that the telecom sector gets a big positive out there. So if I look at it, just to sort of summarize, we're saying agriculture, FMCG, pharmaceuticals, FMCG, I'm including food products also, banking, BFSI sector, telecom sector, government sector. These are the ones which are going to drive the economy. So therefore, when we get this number of positive, it's essentially because of these numbers. There could be a very high downward bias in case our assumptions about things not getting back to 50% of normal in October does not really work out. We could actually go into the negative territory. And given this kind of a scenario, we're talking in terms of getting out of a lockdown. I would tend to believe that there are three main challenges which we have to address based on the developments which have taken place. One is labor. Now, this entire sordid story we've had about the migrant laborers, the question asked today is that when we went in for a lockdown, why didn't we let them go home immediately? Why did we keep them in a transit camp and then say after maybe 4 or 5 weeks that, look, you people can go home? I think it has actually broken the morale of these people. So just at the time when we felt that we should be opening up in a minimal manner, we have actually sent a lot of labor home. Now this labor actually works in construction. They work in your SME segment. So these are the two major segments where they work. Your entire retail space, your physical retail space, like your malls, which are large employers. Now these are the people who have been sent home or they're still on the way home. Now just think of a situation that we go back to normal. Now if a company like XYZ had employed, say, 10,000 laborers who have all gone back to the villages, and tomorrow I say, look, all of you please come back. Are you going to have any trust in coming back? A, we don't have the system, we don't have the transportation system, so these guys cannot come back even if they want to. But even if they want to come back, they'll say that, look, you people never looked after me when you had to shut down. And all these stories are floating around saying that there could be a strike too coming of coronavirus maybe after 6 months. Everybody has their own theories these days. It's quite scary, in fact. So people will be very reluctant to come back. And as long as people don't come back, I have a major problem in terms of how do I produce goods and services. In fact, the entire service sector we're talking of, especially of these petty traders who are there, they've all moved out. Now, how do I get them back into the system? That's going to be the first challenge. Second, relating to labor, we have logistics. Now, logistics is very important because that is how we move people and we move our goods. Now, we have been talking to quite a few of these clients who are in the ports, dealing in the ports. They say our ports are full of goods because lots of goods have come from in form of imports. However, we are not able to transport them. SEZ says, look, we are able to produce certain goods because we've been allowed to do so. I cannot move them out. A, I don't have labor. Even if I'm able to produce them, I'm not able to load them onto trucks because I don't have truck drivers. They've all disappeared. Even if I have the truck driver, I'm told the port cannot accept the goods. There's no space. So we have this kind of logistics issue which is there across the country. And it's primarily on account of this federal structure we have, federal laws. Everybody has a different law. They have their own rules about what can move, what cannot move. And this has created the second challenge for us as we think about unwinding. The third is one of liquidity. So now, liquidity is important. It can be looked at in two ways. I'm an SME today. I produce goods for an automobile company. I've prepared certain parts, sold it to the company. Now, that guy is not able to finish production because there's a shutdown. There are no sales anyway, so he's not going to produce. If I produce, I don't know where to keep it. The dealers have all closed down. So what do? I don't make my payments. So receivables is one of the major challenges, but you have it not just at the SME level, at all the levels. So you talk to any company, they'll say my receivables, which were earlier around 20% of sales, have gone up to 40%, 50%, because I don't have regular payments coming in. And I don't have regular payments coming in because I don't have sales happening. So I need to sell goods to get money so that I make my payments. If I'm not able to sell goods, I will not be able to make my payments. So therefore, there is money which is stuck there. We also have a liquidity issue when it comes to getting finance. Now, if you're a large company, you probably have bank finance, you're able to raise bonds, so you still have access to finance. But if you're a smaller companies, there's this whole question of saying that, how do I get funding? How do I keep my enterprise running? And that's one of the reasons why they've actually closed down, saying that I'm not able to get finance. I'm not able to produce. I'm not getting my receivables, my payments on time. So therefore, I'm closing down my activity, and therefore people have been laid off. Now, here there has been some interesting intervention which has come in from the Reserve Bank of India, where they brought in this concept of moratorium. So the moratorium basically says that for 3 months, you don't have to make your payments. We don't treat it as an NPA. You come after 3 months, and then you can make the payment. But the fundamental question is that if I've closed down for 3 months, I'm not operating, definitely for 2 months, it's been zero production, will I really be in a position to repay my loan in the month of June or July when it falls due? The answer is no, which really means that there has to be a rollover of this moratorium. Now, the RBI has also increased the working capital limits by 10%, saying that, okay, I'm an SME, I've used up all my limits. So therefore, there's a 10% increase which has been made. And I think these two measures have been very positive, especially for the SME segment and for entire corporate sector, but it only gives you breathing space. It's not a waiver. I have to pay it at the end of the day. And until activity revives and I'm able to produce and sell goods, I will not be in a position to honor my debt commitment. Now, the RBI has also infused a lot of liquidity into the system. You might have heard of these long-term repo operation, targeted long-term repo operations, TLTRO. Essentially, they said that, look, we're giving you 1 lakh crores to the banks, and the banks can invest them in the bond market, 50% in the primary market, 50% in the secondary market. Now, what did the banks do? They said, okay, we take this money. It was very successful. They went to the bond market. They saw who are the companies who are raising funds. Oh, I have a PSU which has a AAA rating. Let me put money in that. So the 1 lakh crores got absorbed. Later on, the RBI came up with a TLTRO version 2, where they said we're giving money which has to be put into NBFCs. Banks went, took the money, they looked at the NBFCs which are rated AA or AAA, invested money out there. The lower rated NBFC said, we want to raise money. The bank said, sorry, we're not interested. So when we had a TLTRO auction take place of 25,000 crores, just around half of it was actually subscribed because banks have become risk averse. Talk to bankers and they'll say that, look, we have a situation where we have been asked to increase our working capital limits. We have done that. We have been asked to give a moratorium. We have given that. But the question is, should I be lending more money to a person who doesn't have the ability to pay today? So there has been a lot of risk aversion because you talk to a public sector banker. We have been doing that. And they say that I give a money today, after 2 years, it becomes an NPA. And I don't want the CBI, the CVC, CIC, all of them running after me. Let me play safe and lend only to the best rated clients. So there has been a problem of risk aversion, which has increased. And that's one of the reasons why we have seen that there is surplus liquidity in the system of around 7 lakh crores on a daily basis are being invested in the reverse repo auctions. The RBI has given a lot of liquidity in the form of LTROs. There has been the CRR, which has been cut. They have reduced the minimum CRR requirements. So this surfeit of liquidity, which is there today in the system, can be ascribed to what the RBI has done, but that is not really leading to these resources being channeled for those who require it. Now, we have seen that the RBI has mentioned, the government has also announced a higher borrowing program of 4.2 lakh crores. So banks look at this as a very good opportunity. There's going to be more government borrowing. More government borrowing means more government papers, government securities. More government securities means the 7.5, 7.7 lakh crores which is being put in reverse repo can be really invested in the government securities. It's a safe investment as far as banks are concerned. You're borrowed at 4.4% from the RBI, but that's how the TLTRO goes. You can invest it in the government security, maybe at 6%, 6.5%, depending upon what the tenure is. It's still, you make a nice spread on it without any risk being run. The bank's major problem today is that while today non-payment is not classified as an NPA, at some point of time, if the economy doesn't recover. Now, we are saying 1.2% growth, others are saying negative growth. If there is no growth in the economy on March 31st, 2021, most of these loans which have been gone for a moratorium will be classified at NPA at some point of time or the other. So that's a major risk which is there today, that the NPA number, which is today in the region of around 9.5% for the banking system, could actually spiral and become something like 13, 14, 15%. It's just a wild guess I'm taking today, but the fact remains, just remember, if I'm taking a moratorium, And I believe 90% of the customers have taken a moratorium. Even if they had the ability to pay, they said, look, I don't know about my cash, my liquidity in the next 3 months. Let me go in for the moratorium. So we're not quite sure how many of them don't have the ability and those are doing it for better cash management. But the fact remains that the NPA levels are definitely going to increase at some point of time. It may not be in 2021 March, it could be in June. We don't know how the NPA rules are also going to be changed. So this is one issue which is there. Now, as far as the government is concerned, what has the government done? In March, they announced a 1.7 lakh crore rupees relief package. Now, they said that's meant only for the poor. There were cash transfers being done. To my mind, it was not adequate, but at least something is better than nothing. They've given free food grains to lots of people. I believe it has worked very well for all those who had a ration card. They're trying to plug the gap of people who don't have the ration card. Yesterday, the finance minister said anyone can go and get it. So therefore, that is an improvement which is happening now. But that is a 1.7 lakh crore program which has been brought in by the government. Now, based on this 1.7 lakh crores, the 4.2 lakh crores of extra borrowing which you have said, we believe that the fiscal deficit, based on just these two numbers which we have in front of us, could come to something close to 5.5% to 6% of GDP against 3.5%, which was targeted at the time of the budget. Now, we ascribe this higher government borrowing program primarily due to revenue shortfall. Why revenue shortfall? We have seen that when there's a shutdown, 1 month, 2 months for certain, GST collections are lower. We were supposed to have 1 lakh crores of GST collections every month. Now, quite clearly, we wouldn't have gotten more than 20-30% in April because most of the food items are exempted. I don't know where these numbers could have come from, but maybe not more than 20% is what we're saying. Corporates are going to make losses this year. If I make losses, there's no corporate tax collection. Income tax collection is going to come down if people are out of work. If people are getting lower salaries, if they're working in the airline or hospitality industry, they're saying no salary for 1 month, 2 months, 3 months, 4 months, which means I don't get income, I don't pay tax. I'm saying this, foreign trade is going to come down, global recession, which means overall global trade down. Assuming that we take care of the logistics challenge which we have, at the end of the day, if trade doesn't take place, my custom collections also come down. So putting these factors together, we'll say that the revenue shortfall, we're having a fiscal deficit in the region of around 5.5% to 6%. Now, what has the government done in the last couple of days? They've had measures for the SMEs where they say 3 lakh crores of credit will go to SMEs. This actually happens in the normal course. So banks have to give certain amount of finance to agriculture and SMEs which come under priority sector lending. So when you say Kisan credit cards, 2 lakh crores, that is something which happens in a normal course of activity. So therefore, one should be a bit careful while interpreting these numbers. It's not additional funding happening, it's what the banking system is providing. In fact, we made a calculation that based on what happened day before yesterday and yesterday, the government's actual outflow wouldn't be more than 50,000 crores. The rest of it was actually coming to the banking system, but the caveat attached here is that loans given to the SMEs will be fully guaranteed by the government, which is a big positive. Today, banks don't want to lend to SMEs. Tomorrow, I lend to them now, and I know it's guaranteed by the government. Banks have that much of comfort. Similarly, the package talks of 75,000 crores of funding for NBFCs. These loans are being partially or fully guaranteed by the government. That's a positive for NBFCs because NBFCs get the money. They'll be able to lend it to those who require. NBFCs have a very good last mile connection with the customer compared to banks. So therefore, this is a positive for them. Similarly, we're talking about the thing of 90,000 crores, which is being given for the discoms. It's actually the PSUs who are going to raise the money and put it. So it's not coming from the government's coffers. So therefore, the government has played it quite prudent when it comes to managing the fiscal deficit. And therefore, we feel that the worst possible scenario, further slippage is taking place, we could move somewhere towards the 8% mark fiscal deficit. But the government's program so far is 20 lakh crores. I think around 16 lakh crores were accounted for till yesterday. We saw that 1.7 lakh crores in package 1, 50,000 crores in your package 2 and 3. So around 2.2, 2.5 lakh crores would be the maximum coming actually from the budget. Even the 1.7 lakh crores, we are assuming that it's fresh money and not existing NERIGA funds which are being used there. It's not the existing food subsidy of the PDS. So we're not seeing too much of a slippage as of today. I think what the government is doing is that the economic package involves more of facilitating better flow of funds. Now, being a pessimist, you may say that, look, I'm giving more credit, but how is the person going to repay it after 1 year or 2 years when there's no activity? This is a pertinent question because the indebtedness will definitely increase. The possibility of NPA also increases. But on the whole, the way I look at this 20 lakh crore package is that It's more a case of making sure that where there are certain loopholes, plug them. If people are not getting their cash transfers, give it to them. If they're not getting food, give it to them. If they're having problems in terms of raising funds, give it to them. But in terms of actually giving cash transfers, I told you it's not more than around 2.2 lakh crores, which has been done so far. My suggestion would be that they should be more aggressive, give more money, maybe 4 or 5 lakh crores should be transferred to farmers, to the SME units. You have them, all of them are registered, you know their names, you know the people who are working, transfer to their accounts. That will be a more positive step. Because this is something which countries like UK and US have done. They've given direct cash transfers to individuals. So this is something which probably the government can do. And I'm quite sure they will be looking at the option of how best to do it, because I'm quite sure pushing 5 lakh crores into the system immediately is not something which is really feasible. But I think depending upon the way in which things pan out, we could be expecting more affirmative action coming from the government. So just to summarize, low growth this year, few segments to do well. There'll be a lot of pain. During the first half of the year, don't expect anything to change. Second half, maybe there could be some improvement, but more in the manufacturing sector, not really in the service sector. Things like construction, real estate, hospitality, I think they will have to wait for another year before they can really recover. It will be more in terms of the essential commodities, more in the manufacturing sector, which are going to do well. NPAs to rise, better flow of credit, fiscal deficit to go not really out of hand. It will be higher than 3.5%, maybe 7.5%, 8% at the end of the day. But there won't be any pressure in terms of liquidity because there's lots of liquidity in the system. So government financing it is something which, the financing it through the banking system should not be a major challenge. So I think this is where I'll end, and we can carry on through the Q&A session.
I think. Hi, this is Harinder and Madan. That was really a really good summary of the economic situation here. Now, I have 2-3 questions for you, all bunched together, and I think you have partially answered all of them, but I'd still like to hear from you. My understanding of this 20,000 crore package is that we have taken care more on the supply side rather than demand side. So, what are your 2-3 suggestions to improve on the weaker demand? That is one question. Second question is that if you are the finance minister, how do you balance between a weak growth, the estimates range, as you rightly said, from negative to 1.2% on one side, the growth, and the deficit going from 3.8% to 6 to 7%. So how do you balance that? And last question is, if you have to do a crystal ball grazing, when do we get into the annual growth of 6, 7, 8%?
Okay, so if let me hope I remember your questions. One in terms of demand, I think yes, you're right. I think if you look at the way in which the government has come up with its policies, see all through. I think even if I go before the COVID attack, I think the government's intervention has normally been on the supply side. Right. So even earlier when we had a problem in the real estate sector, the Bharat 6 problem in the auto sector, I think you try to plug in the policies which affect the supply side. See, demand side is something which happens only in course of time, and the only way you can do it is by direct cash transfers. And there are limitations out here, there's hesitation out here. So I think unless we go in for something very aggressive in terms of cash transfers, only then can we revive demand. I mean, normally demand revives when you create more jobs and incomes increase. Unfortunately, we have a situation here where unemployment level has gone up. Going by the latest CMI data, it's some 22% or so, which is horrendous. So if I have an unemployment rate of 22%, it's going to be very difficult to create demand. So I think this is something which the government can do, and I think they should forget about the fiscal deficit. I don't think any rating agency is looking at the fiscal deficit. All countries are running high fiscal deficits. One has to be a bit bold to take the stance of saying, I spend another 5 lakh crores, transfer money into people's accounts. In fact, I think even people like you and I should probably get a tax refund. You said instead of paying 12 months tax, you pay 11 months. No, actually, we are the people who have the spending power. I should be. Today, the thing is that all of us are cautious. I don't know if I'm going to get my salary or not. See, lots of us are working in sectors where there is a threat that if the company doesn't start operating, we may not get a full salary, in which case I stop spending. We need to make sure people have money to spend. So I think at all sections, you will have to start saying that I compromise on my fiscal and make sure that I'm able to create purchasing power. I think that should be the thing which the government can probably take up. And what was the third question? Sorry, I've lost
third question is crystal ball grazing. That when we get to
No, I think that's going to be a long way off. I think this year is gone, and the way we'll recover is probably a 5-6% next year if everything returns to normal by March 21. And those and even those numbers of 7% or something, I would say at least 3%, 3 years away.
Okay, that's great. Thank you very much. And I have to thank both you and Nilesh Bhai for wonderful exposition. I think all our attendees have benefited from that. I would also like to thank all the people who have attended this webinar. Please do fill in your feedback form so that we can improve on it. Thank you so much again for joining in.
It's a pleasure. Thank you.
Thank you.
Bye-bye.
Thank you. Bye. Bye.